Hello everybody, welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about the forecast that home prices are going to go up in 2026. And we're going to talk about why that is. All of this data comes from the annual NAR Forecast Summit, where the chief economist of NAR goes through like a bunch of technical data, explains what's going on in housing. We're going to share all data with you.
All right, let's go.
Do you like that? Okay. So we're going to start with, we're just going to go through charts to talk about them. And quick reminder, if you subscribe to our channel, or if you are a subscriber to our channel, you get to watch all the videos ad-free within the first 48 hours when they come out. So if you don't want this, if you're new to the channel, subscribe and you won't get any advertisements during the video. All right, so here we go. This is the chart. We'll spend some time on this, talk about this. This is a nationwide forecast. And this is a couple things in here. It's got 2025, 2026. I'll explain each one of them. Okay, it says existing home sales. So 2025, the forecast this includes the rest of the year, of course, is it up 3% from last year, 2024. Juana, what does this mean, existing home sales?
So not new home builders, so homes that have been previously lived in.
And then what does sales mean?
So number of units.
It's not the price appreciation, it's numbers of units. So they're saying that if we sold 4 million, we'll sell 4 million, 4.12 million next year, right? Or this year. That's the sort of forecast. And then what it's showing for next year is 14% more than 2025. What do real estate agents generally care more about? Do they care if the prices go up a couple percent or down a couple percent? Or they care if there's going to be more sales that happen?
Real estate agents are focused on the number of transactions, not necessarily the price appreciation. That doesn't mean as much as the number of transactions. So the more transactions real estate agents do, then it is much more likely that their income will be higher than simply some appreciation.
Okay, the next one, new home sales up 5%. That was from 2024. The forecast in 2026 is new home sales up 5%. This is the total numbers of sales, numbers of houses sold, not the prices of the houses.
Right.
Okay, this is the sort of important one. Median home price, 1%. That's the estimate for the year, 1%. Now, we've got a great chart that shows this. Home prices tend to go up and down throughout the year. Spring they go up, fall they go down. The net is expected to be up 1% from December of last year. And then they're estimating 4%. One is 4% completely out of line with historical standards for home price appreciation.
4% is actually very modest.
And if you remember 2020, 21, 22, it was way more than 4%. Okay, the mortgage rate currently about 6.7%. That's the Freddie Mac 30-year median. And they're estimating about 6%. Which will be nice for the people buying those extra 14% of houses. They get a little better rate. Job gains, 1.6 million is the estimate for the year. They're estimating 2 million next year. What's interesting is we probably won't build 1 million homes. They'll probably build like 800,000. So no, that's not even one home for every 2 jobs,
right,
that are added. Okay, so first thing we want to show you is the historical change. This is the regional comparison of single-family home prices. Now, it's been broken into 4 categories: Midwest, South, Northeast, and West. What's really interesting is all these little ups and downs. Every one of those is 1 year. That's simply the annual home prices go up, they go down, they go up, they go down. They go down usually like 3% spring to fall, and then they go up 8% fall to spring. And then they go down and they go up, and they pretty much do that. This is very granular. You can actually see this in this chart very well. Why would the West have higher, not necessarily percentage, but just higher dollar amount than, say, the Midwest for appreciation of homes? Because that's what this is. It's a price chart.
So we have 2 things, right? People are interested in living on the coast, so West Coast, East Coast.
Okay.
And the second thing is economic opportunity. Economic opportunity definitely is more important than the coasts, but the coasts tend to bring more economic opportunity too, for a lot of reasons. One, because these are ports of entry, right, for goods. The other reason is that we have a lot of growth in these areas. So we have manufacturing, we have all kinds of jobs. So jobs lead to people wanting to move there. So that's what fuels the growth in real estate in those areas. You have people who are coming in, they need homes, and that's what fuels it.
Right. If you live in Ohio or Indiana, you don't have as much economic opportunity as if you live in Boston, New York, San Francisco, places like that, where there's higher paying jobs, tech jobs, things like that. So home values are more, especially California coast, the Puget Sound area and all that, right? Okay, speaking of jobs, this is the actual number of payroll jobs for the last 5 years. This is a very misleading chart because the bottom of this chart is 120 million. Okay, if this chart was full from zero, it would almost look very flat with just a little dip. And those were the people that were temporarily laid off during the COVID. The other thing that's interesting about this chart, and we didn't make it, the NAR made it, but it's because it's every month. So there's 60 lines in there, and it looks like it's very shallow increases, but remember, it's every month there's more jobs. So this is just part of their data when they analyze this, right? Why is it important if there are jobs growing? How does that impact real estate prices maybe?
Right. So growth in jobs means that there's more money in the economy, and when you have more money in the economy, then people want to do something with that money because that's the way we're wired, right? And one of the primary things that people want to do, it's part of the American dream, right? Probably the number one thing of the American dream is home ownership.
Yep.
So that's what you see people going out and wanting to buy a home.
The other thing this next chart shows, this is the federal funds rate. Now, this is over the last 50 years. Now, what's interesting is there's 3 times in the last, or 25 years, 3 times in the last 25 years that the Fed has jacked up rates to stop some bad thing, transitory inflation from happening, right? And generally in the aftermath of these rates going up, we have a long period of time where rates drop, and then they stay at some low level. Almost always during those times, historically, literally all those times, home prices are going up. Okay, home prices are going up because, Juana, what happens to the economy when the Fed lends money at a very low rate, overnight rate to banks?
Well,
like less than 1%.
Right, so it just causes a lot of economic activity. And part of that economic activity is job growth, and it's increase in wages and that sort of thing. So that enables people to go out and buy homes. And as as interest rates drop, then that emboldens more people to take the step and go for home ownership.
What you'll note that's most interesting about this is that, of course, and you can see that the last time the rates dropped, which is basically right around COVID time, they went back down. That was the big run up in prices. Well, we've survived. Like real estate has somehow survived this massive rate rise. It's basically the second highest one we've had in 25 years, but we're in the long path. We've survived it. Like home prices didn't tank. In some markets they're down, but for the most part, home prices are flat or up a little bit the last few years. And now, looking forward, what NAR is looking at is we're in a situation where the Fed's going to be cutting rates over time. We may get to a time in 26 or 27, we just get down to some much lower rate. They stay there for a long time. The economy just grows and grows and grows. So what they're looking at is they think most of this is behind us. Do you sort of agree with that?
Right. I think the Fed is pretty satisfied that inflation is going to stay under control. The Fed just wants to be very cautious as far as lowering rates so that inflation does not return and get out of control, because the Fed really has very limited tools at this point to get inflation under control again.
Okay. The other factor they're looking at is this other chart. This is the inventory of homes over time. Now, this chart goes back 25 years, and it's got this red line at 2 million, which is roughly the average over the last 25 years. Now, you can see at one point we got below $1 million, and that was when the market was, stuff flew off the market. At one point, we're at $4 million, and $4 million was the housing crash, right? What's interesting, a couple things about this chart, Juana. The up and down of inventory over time is very pronounced here. And you can see we're in the phase of the up, which is starting to, like, it's going to start shallowing off, level off, and then 4 or 5 months from now, inventory is just going to start dropping again. And we don't know, is it going to drop to the lows of this year? Is it going to go more? Maybe not that much. We don't know. We'll find out. But we're not even back at the level of homes that we had on the market in 2000, 25 years ago. We had 2 million. Juana, the country's bigger than it was 25 years ago.
Right. There are more existing homes to start with. We have a greater population, and yet the numbers are lower than they were 25 years ago. So what does that tell us? Well, it tells us that there's a lot of room for appreciation, right? Because we have supply and demand, we have low supply, and by definition of the fact that we have just more people, we're going to have the demand.
I think this is when I hear people say, why are homes going up? This makes no sense. This is why. I remember hearing that it was going to, and it's written on the chart, it would take 40 years to get rid of all that inventory in Miami because there were so many homes on the market. What happened is overseas investors came and bought it all up. It's super low. They were buying these high-rise condos for $50,000 each, and those condos are $800,000 now. Probably a pretty good investment that those people made. The other thing on this chart is if you see down there that locked in forever is no one will give up their 3% mortgage. You know, between 40% of homes being free and clear and so many people having super low mortgages, that's the reason why it's going to be very difficult for inventory to get high enough to cause downward pricing pressure on homes, which is part of NAR's looking at this, why they're saying home prices go up 4%. Here's the other one, the dreaded foreclosures. The mortgage delinquency rate, 90-day late rate, is about the lowest it's ever been. It's super low. That's the blue line. What the red line is the actual number of foreclosures. Now, what's interesting about this chart is it only goes to 6%. This is not, you'll be like, oh, that looks like it's 10%. It's 10% of this chart, but this chart's only 6%. If the top of this chart was 100%, the red line would basically look like it's going on zero. It's 0.3 or 0.4%. It's basically zero. It's not enough to effectively do anything in the market, right? So there's no risk of some foreclosure activity or anything that would cause a bunch of houses to come on the market that would push down prices. At this point, the only reason a home would come on the market is because a builder would build it or someone would sell their home. And right now there's more people waiting to buy houses than there are to sell houses, which is what's causing prices to go up.
Got it.
Okay. All right. The other thing, this is real estate net worth. And what this shows on the chart is how many trillions of dollars people have just in their equity, not the total price of the house, the equity. What's the difference between the price of the house and the equity in the house?
So the price of the house is the value of the house, and the equity is the difference between what you owe on the house and the value of the house. So
40 trillion, there's about 2 trillion sold every year. About 5% of the housing market comes on the market roughly every year in general. It's less right now for sure. So it takes us 20 years to get through all the houses. What's interesting though is this next chart. The difference between the red and the blue line, and the red line is the actual debt, how much mortgage debt there is. The difference between the red and the blue line is the chart you just saw. This shows that we have the highest percentage of equity that we've ever had. We actually have less than 30%, just under 30% of all real estate has any mortgage loan on it.
Right, we're talking about residential right now.
This is just residential. Juana, what does that do towards seller, like this whole idea that sellers are forced to sell because prices went down by 5% last year, over the last year in their market?
So very few people are in distress and have to sell, and most people have sufficient equity to weather whatever is happening in their lives. That means that sellers don't have to take a super low offer. sellers can wait for the right offer. Sellers can take the property off the market and come back at a later time. They have a lot of flexibility that somebody who is in distress does not have.
There are certainly people fishing.
Sure.
What does that mean, sellers fishing?
So that you call it fishing, I call it optimistic or aspirational pricing, and we all have that, right? So a seller will say, if I can get a ridiculous amount of money for my house, I'm out of here. But if I don't get a ridiculous amount, I don't have to sell. I'm not interested in selling. I really have nowhere to go, so I'm okay with not selling. That's what fishing is.
Okay, I'll put this chart back up here. This is the first chart we started with. All of these numbers are backed by all the data that we looked at. And I do realize that there are some markets, like this is aggregate data. Juana, what does aggregate mean? It's an economic term.
Right, so they're looking at the whole nation. They're not looking at your specific market.
Yeah, there are certainly some markets. Austin's been down a couple years. Miami's been down. Tampa's been down.
Okay, but down from the highs, not down as far as when you're looking at the market as a whole and what they've been doing for the last 7 years, for example.
The video we're going to do after this, we're going to break down the 50 largest markets. We got this great chart. 20 of the 50 largest markets have had price declines. 30 of the 50 have had price increases. Mm-hmm. We're not going to tell you which one Vegas is in.
You can guess in the comments.
But the smallest over the last year or the largest decline has only been between 5 and 6%. Mm-hmm. So we're not talking massive crashes. This happens every year. Every market doesn't go up. There's factors that affect markets. Maybe people are leaving a market. Maybe too many people moved into a market. Maybe they overbuilt in a market. These things don't work themselves out over time generally, mm-hmm. right? So when you look at these numbers here, more sales in 2026, slightly more new home sales, home prices going up, mortgage rates probably dropping, more jobs. This looks reasonable. This year is sort of the last of 3 years of what I want, and we called it 3 years moderating prices. Prices weren't going up. We said they wouldn't go up. We said they would moderate for a few years. And I think we're done with that. I think whatever price declines we have going into the fall is the last gasp. And probably the best time to buy a house in the next 10 years is sometime in the fall, probably October, November, December.
Unless you find the perfect house now, in which case go for it.
Yeah. And that's it for the chart.
All right. Hope you enjoyed the video. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us your real estate related comments. Guess where Vegas is going to be on the next video for price appreciation versus depreciation. And we'll see you on the next video. Bye.
Bye.